Imagine burning billions of dollars for a decade, enduring endless price wars, fighting global regulators in court, and just generally being written off by half of Wall Street as this totally flawed business model.
Yeah, a total cash furnace.
Right. Only to wake up in 2026 generating over $1 billion in pure free cash. Today we are dissecting how Lyft stopped bleeding capital and quietly became this highly profitable robotic fleet landlord.
It's quite the turnaround.
It really is. Welcome to the deep dive. We are doing a special Talk Tickers format today, designed specifically for you, the retail investor trying to make sense of all the noise.
And, there is certainly a lot of noise out there. I mean, the market has a tendency to look at the ride-sharing industry through a rearview mirror.
Oh, for sure.
They just remember the venture capital subsidy days of the 2010s. But the fundamental architecture of this business has matured. It really has.
Exactly. And our mission today is to cut through the corporate jargon of Lyft's Q1 2026 earnings call and deliver a really data-forward, actionable analysis.
Which is usually hard to do quickly.
Right. Usually the Talk Tickers format tries to do this in under 5 minutes.
Yeah.
We give you the quick headline numbers and get out.
Yeah.
But the data coming out of this specific earnings call is so massive and frankly so paradigm shifting for the whole transportation sector that we are expanding it.
We kind of have to.
We do.
Yeah.
We're going to spend the time turning this financial briefing inside out so you actually understand the underlying mechanics of what is happening here.
Because the hook here is just undeniable. I mean, Lyft isn't just surviving the murky waters of the gig economy anymore.
No, not at all.
They are throwing off staggering amounts of cash, and they are actively laying the physical concrete for a driverless future.
That is the pivotal shift we have to analyze. This is not the Lyft of 2019 desperately offering coupons just to retain market share.
Right.
The Q1 2026 call is really the ultimate proof of concept that their long-term strategy shifting from a purely digital matchmaking algorithm to an integrated physical infrastructure network is actually working.
It's working incredibly well.
Okay, so let's unpack this by starting right where the analysts start, which is the raw data.
The fun stuff.
The top line and bottom line numbers coming out of this quarter are, honestly, they're eye-opening. We are looking at gross bookings up 19% year over year.
Which is massive at their scale.
Massive. Meanwhile, adjusted EBITDA, which is basically their operational cash profit, is up 25% year over year. But let's make sure we're all on the same page with the mechanics here.
Yeah, plain language translation.
Exactly. Wall Street throws around these terms constantly, but we need to break it down. Think of gross bookings as the total toll collected on a massive highway system.
Right.
That is the gross dollar value of all the rides, all the money moving from rider credit cards into the system before Lyft takes its cut.
Yeah, it's the total volume of commerce flowing through the network.
And then you have adjusted EBITDA. If gross bookings are the total tolls collected, adjusted EBITDA isn't just the slice Lyft gets to keep.
No, it's what's left after the bills are paid.
Right. It is what is actually left over after they have paid for the toll booth operators, the server maintenance, the credit card processing fees, and, the core corporate overhead. It's their core cash profitability.
And what is fascinating here is the relationship between those two numbers. I mean, look at it. The profit, the EBITDA, is growing at 25%, which is significantly faster than the 19% growth of the overall booking.
Which means operational leverage.
Exactly. It means they are extracting more inherent value out of every single transaction.
They're not just buying growth.
Right. They aren't just growing by brute force or by artificially buying revenue. The system itself is getting more efficient. But if we connect this to the bigger picture, the most staggering numbers from this call aren't just the percentage growth metrics.
No, it's the absolute cash.
It is the absolute raw cash generation.
Yeah, the cash flow numbers are what made me stop the audio recording of the earnings call and actually rewind it. I had to make sure I heard it correctly.
It's pretty wild. Over the trailing 12 months, Lyft has generated a record $1.12 billion in free cash flow.
$1.12 billion.
Yeah. And in the first quarter alone, they executed a record $300 million share repurchase.
Okay, here is where it gets really interesting for you as an investor tracking this stock. If you read the transcript of the Q&A session with the analysts, you do not see management prominently featuring traditional earnings per share, or EPS.
They barely focus on it.
Right. And for decades, EPS was the holy grail metric. It was the only thing anybody on financial television fretted over.
True.
Instead, Lyft's management is aggressively pushing the narrative toward this free cash flow number. So as an expert looking at this balance sheet, Why is that specific $1.12 billion free cash flow metric such a significantly stronger story for them to tell right now than traditional EPS?
Because free cash flow is undeniable reality. I mean, earnings per share is an accounting metric, and frankly, it can be massaged.
Lots of levers to pull.
Exactly. EPS is heavily affected by all sorts of non-cash accounting maneuvers. You have depreciation of assets, amortization of past acquisitions, and crucially in the tech sector, non-cash stock-based compensation for employees.
Right, the SBC.
Right. So you can have a positive EPS but be bleeding cash, or you can have a negative EPS but be filling your bank account to the brim. Free cash flow just cuts through all that accounting fog.
It's the actual tangible money left in the corporate bank account.
Precisely. It's what's left after the business has paid all of its operating expenses and all of its capital expenditures.
It's the money they can actually use to do things in the real world.
Yes. For a company that spent its early years heavily subsidized by venture capital, constantly needing to raise external funds just to keep the lights on, pivoting to organically generating over $1 billion in cold, hard cash is, well, it's the ultimate validation.
It proves it's a real business.
It definitively proves that the underlying business model is not just a digital novelty. It is a highly viable enterprise.
So let's talk about what they are doing with that cash. Because that $300 million share buyback in a single quarter is a massive signal.
Huge signal.
Right. A company doesn't authorize and execute a buyback of its own stock unless management fundamentally believes two distinct things. One, they believe the current stock price is undervalued by the public market.
Yeah.
And two, they believe they have more than enough cash on hand to fund all of their future operational and growth needs without needing to hoard every last penny.
And that $300 million repurchase, it acts as a shock absorber. It sets a firm psychological floor under the stock.
Oh, absolutely.
When the market sees management aggressively buying their own shares, it essentially tells the short sellers, be careful because we have $1 billion in cash and we are perfectly happy to buy up all the shares you are trying to push down.
It is management putting their money exactly where their mouth is.
They are officially a cash-generating machine.
But numbers, this big 19% growth on the massive top line, 25% on the bottom line, $1 billion in cash, they do not just materialize out of thin air.
No, they definitely don't.
You don't just wake up one quarter, tweak a line of code, and accidentally produce $1 billion in free cash flow. $1 billion is an incredible destination, but let's look at the operational vehicle that actually got them there.
Let's do it.
Because you do not hit those margins without fundamentally changing who is requesting the ride and how that ride is being serviced. What is the actual engine driving this newfound profitability?
Well, the underlying strategy is where we really start to see the operational mastery. And the first major component of that is what they call their partnership engine.
Yeah. David, the CEO, dropped this massive statistic during the Q&A that frankly changes how we should view their customer acquisition strategy entirely.
It really does.
He noted that 27% of all rider requests are now directly tied to partnerships. Think about that trajectory.
It's wild.
Historically, maybe 20% of rides were tied to partners. Then it crept to 22%, then 25%, and now 27%. More than a quarter of their entire global demand is coming through a third-party partner channel rather than organic standalone app opens. But let me play devil's advocate here. Because as a retail investor, my immediate worry when I hear about partnerships is brand dilution and margin compression.
That's fair concern.
Right. Are these just cheap, subsidized promotional rides? If you tell me that 27% of your business is coming from people saying, hey, I get a free $5 Lyft credit because I bought a sandwich, that sounds like a race to the bottom that would crush the exact EBITDA we just praised.
And that is the exact critical lens you need to apply when evaluating gig economy metrics. Historically, you're right. Partnerships were often just glorified coupon codes that attracted the lowest loyalty, highest churn customers.
Exactly, the bargain hunters.
But the data embedded in this Q1 report suggests the complete opposite is happening here. These are actually highly strategic, incredibly valuable customer cohorts.
How so?
Let's look at the two primary partnerships management highlighted, DoorDash and United Airlines. They serve entirely different but incredibly complementary purposes for the balance sheet.
Okay, let's unpack those one by one, starting with DoorDash. What is the actual financial mechanism making that partnership work?
Well, DoorDash is the volume and frequency play. As the CEO pointed out, human behavior is predictable. People eat 3 times a day.
True.
By integrating deeply with DoorDash, and management just announced they expanded this partnership into the Canadian market, By the way, Lyft is tapping into a base of consumers who are already highly conditioned to use on-demand applications constantly.
They're piggybacking on an existing digital habit.
Exactly. It drives high frequency. If a user is already opening DoorDash multiple times a week to order lunch or groceries, and they have an integrated benefit that links to Lyft, it keeps the Lyft ecosystem top of mind.
It's just right there on their screen.
Right. It captures the everyday commute, the quick trip across town to meet a friend. It reinforces the transportation habit without Lyft having to spend millions of dollars on standalone brand marketing to remind that user they exist.
So it fundamentally lowers their customer acquisition cost, or SAC. If you have to run a television ad or buy expensive Google search keywords to get someone to download your app, your CAC is incredibly high, which means it takes a dozen rides just to break even on that user.
And hope they don't churn.
Right. But if DoorDash is doing the marketing for you to their captive audience, your acquisition cost drops through the floor. So DoorDash provides the bedrock of volume. But then you look at United Airlines, and that is a totally different consumer profile.
Completely different. If DoorDash is the volume anchor, United Airlines is the margin anchor. Let's think about the demographics here.
Okay.
United Airlines passengers are heavily skewed toward corporate business travelers and international leisure travelers. And where do those people need to go?
The airport.
The airport. And in the rideshare industry, airport rides are the undisputed golden goose.
Why are they so lucrative compared to just a normal ride?
Because the unit economics of an airport ride are entirely detached from your standard Tuesday afternoon trip to the grocery store. Airport rides inherently cover longer distances, which means a higher gross base fare.
Right, it's a longer trip.
Plus, they usually involve luggage, which means users are more likely to upgrade to a larger vehicle, like an XL, which carries a premium price.
That makes sense.
And crucially, business travelers are completely price insensitive because they are expensing the ride to their corporate accounting department.
Oh, that is the best part. They don't care if the ride is $45 or $65.
Exactly. They just want to get to their terminal on time. So because the gross fare is higher and the user is less sensitive to surge pricing, the profit margin Lyft extracts from that single airport trip is massive.
Wow.
Furthermore, Lyft historically over-indexes in major United hubs. Places like Chicago, Houston, Newark, they have established a dominant physical presence at those specific airports.
But let's look at the cost of this partnership, because on the call, they mentioned they have awarded over 350 million airline miles to riders through this integration.
That's a lot of miles.
It is. So again, pushing back on the margins, somebody has to pay for those miles. United doesn't just mint frequent flyer miles for free and hand them to Lyft. Lyft has to purchase those miles on the back end to reward the rider. Doesn't that expense eat into the profit?
It does represent a cost, absolutely. Lyft pays a negotiated wholesale clearing rate to United for those miles, but the return on that investment is staggering.
Because of the margins.
Right. You are sacrificing a tiny fraction of the margin to guarantee that a high-value corporate traveler chooses your app over your competitor's app every single time they land in Chicago. It is a phenomenal trade-off.
And what's wild is that they just escalated this partnership to a completely new level.
They did.
Management announced what they called an industry first during the Q1 call a Pay with Miles feature for United Mileage Plus customers. This isn't just earning miles anymore, this is spending them.
This is huge.
Let's walk through the actual flow of funds and consumer psychology here.
This specific feature raises incredibly important questions about consumer psychology and ecosystem lock-in. Think about the macroeconomic reality. There are billions, if not trillions, of unused airline miles sitting dormant in consumer accounts.
Oh, for sure.
They are an invisible digital currency that people feel they have, earned, but rarely have enough of to actually book an international first-class flight.
Right, you have 40,000 miles and you can't do anything with them.
Exactly. So by allowing riders to literally use their United miles as liquid currency to pay for a Lyft ride, they are creating an incredibly sticky, locked-in ecosystem.
It's brilliant because it feels like free money to the consumer.
Precisely. If you are a United loyalist sitting on a mountain of 80,000 miles and you land at Newark Airport, you are never even going to open a competitor's app to check the price.
No way.
You are going to open Lyft because you can pay for that $60 ride to Manhattan using your digital airline miles. Your out-of-pocket cash cost feels like zero.
Which is amazing for the user.
And United clears a dormant liability off their balance sheet. The user feels like they got a free luxury ride. And Lyft gets a guaranteed high-margin airport dispatch without spending a single dollar on traditional marketing. It functionally lowers the churn rate of those high-value users to near zero.
Okay, so you have this barbell strategy with partnerships. DoorDash securing the high-frequency base, and United locking in the high-margin corporate traveler. But partnerships are just one lever they're pulling.
Right.
The other major engine driving this EBITDA expansion is what Wall Street analysts love to call premiumization. The CFO, Aaron Brewer, specifically noted on the call that higher value modes grew by over 35% year over year.
That's a massive growth rate.
It is. That is encompassing modes like Lyft Black, Lyft XL, and this new XXL product designed for big families or groups with heavy luggage. Wall Street loves the word premiumization, but practically speaking, we are just talking about structural margin expansion through upselling riders to nicer cars, right?
It is the classic upsell, yes, but the margin implications behind that upsell are profound when you look at the digital infrastructure.
Walk me through it.
When a rider chooses to upgrade from a standard Lyft to a Lyft Black, the underlying infrastructure cost to the company is completely identical.
Interesting.
The app interface works the exact same way. The cloud computing cost to route the driver is the exact same. The credit card processing API is the same. The corporate headcount required to facilitate that ride is the exact same. But the gross revenue generated from a Lyft Black ride might be double or triple the standard fare.
Meaning almost all of that incremental price increase drops straight to the bottom line as pure profit.
Exactly. You are increasing your revenue by 100% on a specific transaction while your fixed back-end costs increase by 0%. That is the purest definition of operational leverage.
And David, the CEO, admitted something incredibly candid during the Q&A. He mentioned that Lyft Black is actually their highest-rated ride mode across the entire platform in terms of customer satisfaction.
Yeah, people love it.
But he frankly admitted they have probably underinvested in it and undermarketed it over the past few years.
Which makes sense given the market dynamics back then.
Right. They were so focused on the volume wars, fighting for the cheapest possible ride, that they neglected their most premium, highest margin product. Now they are making up for lost time by rigidly improving the quality standards of the vehicles allowed in the Black tier and focusing heavily on recruiting professional livery licensed drivers.
And they are taking this premiumization strategy even further up the value chain.
Oh.
They recently executed an acquisition of a company called TBR. This is a crucial detail that a lot of retail investors might have missed in the fine print.
TBR.
Yes, TBR operates in the ultra-high-end B2B chauffeur space. We are talking about coordinating complex, non-deal financial roadshows for C-suite executives across 120 different countries.
Okay, so if a bank is taking a CEO on a tour of London, Frankfurt, and Tokyo to pitch institutional investors, TBR is the company managing the fleet of Black cars waiting on the tarmac.
Precisely. It is the absolute pinnacle of luxury ground transportation.
Wow.
Now, why does a mass market rideshare app buy a boutique executive chauffeur service?
Right, that seems weird on the surface.
Management views this as a halo effect that brings their entire corporate standard up. When you have an internal division that operates at a true, uncompromising 10 out of 10 luxury standard, where drivers are wearing suits, the cars are immaculate, and the routing is flawless, it elevates the operational DNA of the entire brand.
Oh, I see.
It allows them to aggressively pitch massive corporate contracts saying, look, we can handle your everyday employee commutes with standard Lyft, we can handle your sales team with Lyft Black, and we can handle your CEO's global roadshow with TBR. It is a complete end-to-end enterprise solution.
That is brilliant. So we have the frequency from DoorDash, the loyalty from United, and the massive margin expansion from upselling to Lyft Black and TBR. But we also have to talk about geography. Because growth isn't just about getting more money out of the same riders in New York and San Francisco. They specifically called out their expansion in Canada, where year-over-year rides grew by roughly 50%?
50%.
Let me just repeat that. 50% growth in a national market.
Which is an astronomical growth rate for a mature technology company in 2026. What we are seeing is Lyft aggressively expanding their total addressable market, or TAM, in geographies that are traditionally underpenetrated by their specific app.
Right.
And it is not just international expansion into Canada. Management highlighted massive, disproportionate growth in low-scale Tier 2 or Tier 3 domestic U.S. markets. They specifically pointed out places like Milwaukee, Pittsburgh, and increasingly suburban or rural areas.
Why the sudden boom in Pittsburgh instead of Los Angeles?
It's the classic S-curve of technological adoption. The major, mature metropolitan cities, New York, LA, Chicago, they are naturally seeing slightly lower rates of percentage growth because of market saturation. Everyone who is going to download a rideshare app in Manhattan already did it 7 years ago.
They're already using it every day.
Great. The market is mature. So to re-accelerate your top-line growth, you have to push into the suburbs, you have to push into the Midwest, and you have to aggressively push into Canada, where the competitive dynamics might offer more white space.
And they are certainly not ignoring the rest of the world either. This brings us to a fascinating, complex part of their strategy. They have been on a highly targeted buying spree in Europe.
Yeah, this is key.
Last year, they bought FreeNow, which integrated them into 9 new European countries. And on this specific earnings call, they confirmed they literally just officially closed the acquisition of the Getz UK business this week. Let's dive deep into the European market, because the mechanics of ride-sharing in a city like London are totally alien compared to a city like Phoenix.
Oh, they are completely different worlds. You cannot overstate the strategic importance of these European acquisitions. Both FreeNow and Getz are heavily, fundamentally rooted in the traditional legacy taxi business.
The black cabs.
Think of the iconic black cabs in London. London is arguably Europe's most important, most lucrative transportation market. But it was also one of the most heavily regulated.
Right.
For a long time, Silicon Valley tech companies tried to enter London by brute force, ignoring the legacy taxi drivers, and it resulted in endless strikes, regulatory bans, and massive legal fees.
Right. The regulators in London require black cab drivers to pass the knowledge, which is a brutally difficult test of the city's streets. They have deep institutional power.
Exactly. They aren't going anywhere. So instead of fighting that legacy system, Lyft bought the digital dispatch platforms that those taxi drivers already use. By integrating with Getz and FreeNow, Lyft didn't just buy a user base, they bought the supply side. Suddenly, the Lyft technology stack is routing something like 70 to 80% of the legacy taxis in London.
That's incredible.
They became the digital backend for the traditional market. But here is the critical long-term insight for investors. These acquisitions aren't just about generating ride volume and revenue today. They are a deeply calculated play for government relations tomorrow.
Oh, this is where we connect the dots to the future. Because legacy taxi unions and companies already have decades-deep relationships with city regulators and transport authorities.
Precisely. Look at the ultimate endgame of this industry, autonomous vehicles.
Yeah.
If you want to operate fleets of driverless robots on the historic, narrow, complex streets of major European cities in the 2030s, you need the explicit blessing of the local government. You need permits, you need regulatory harmony.
You can't just drop robots on the streets.
No, definitely not. By buying companies that have decades of institutional goodwill, companies that the regulators already trust and work with daily, Lyft is building a regulatory moat.
A Trojan horse.
It is a Trojan horse for their future autonomous ambitions. When the time comes to apply for AV permits in London, Lyft won't be seen as a disruptive American tech rogue. They will be viewed as the established, compliant dispatch partner of the London taxi industry.
That is a phenomenal transition into the mechanics of dispatching and efficiency, because there is a financial concept that came up during the Q&A that sounds like absolute accounting magic, but it's the secret sauce to their current profitability.
Oh, contra revenue.
Yes, the concept is contra revenue. The CFO, Aaron Brewer, was talking about driver incentives and stated that contra revenue incentives have actually been a source of immense leverage this quarter.
It's so important.
He noted they achieved their highest driver hours ever in Q1 without blowing up their costs. We need to explain how this actually works. What exactly is contra revenue, and how does the dispatch algorithm manipulate it to create leverage?
This is perhaps the most important metric for understanding the health of a two-sided marketplace. In the ride-sharing industry, incentives are the subsidies the company pays to balance supply and demand. You have discounts given to riders to get them to open the app, and you have bonuses paid to drivers to get them to turn the steering wheel. Contra revenue specifically refers to those incentives paid to drivers that are essentially deducted directly from the gross revenue Lyft collects.
So practically speaking, if a rider pays $20 for a trip, but there aren't enough cars on the road, Lyft might have to offer a $5 surge bonus to convince a driver to log on and take that specific trip.
Right.
That $5 comes directly out of Lyft's take rate. It is literally revenue running in reverse. It's a bribe to balance the market.
That is exactly what it is. In the past, Companies had to pay massive contra-revenue incentives just to guarantee a ride would get picked up within a reasonable time frame.
Yeah.
If a driver drops someone off in the suburbs and has to drive 15 minutes empty to get their next fare, what the industry calls deadhead miles, they're going to log off unless Lyft pays them a huge bonus to compensate for that empty time. Those massive bonuses historically crushed corporate profit margins.
But the Q1 data shows a total reversal of that dynamic.
Yes. What the CFO is telling the market is that they are now getting leverage on that specific line item.
Which means?
Meaning they had their highest driver engagement in company history. The absolute most hours drivers have ever spent logged onto the platform in a single quarter. But the relative cost of incentivizing those drivers went down.
How is that physically possible? How do you get drivers to work more hours for fewer bonus dollar?
Because of algorithmic routing and network density.
Okay.
The marketplace has reached a tipping point of organic density. If a driver drops a passenger off at a coffee shop and the algorithm immediately gives them another ping from a passenger standing on that exact same block, the driver has 0 deadhead miles.
Wow, they just keep moving.
Right. Their utilization rate is essentially 100%. Because they are constantly moving paying passengers, their hourly earnings remain incredibly high and stable, even if Lyft lowers or removes the artificial $5 bonus.
They don't need the bonus because the volume is there.
Exactly. Drivers are actively choosing to drive for Lyft because the platform is healthy, the routing is hyper-efficient, and the steady flow of fares provides a reliable income. Lyft doesn't need to bribe them anymore. This proves the network effects of the business have finally reached maturity.
That is a massive operational milestone. And it is not just the external driver network that is getting radically more efficient. It is their own internal corporate office.
This was a big surprise on the call.
It was. The CEO spent a significant amount of time discussing how internal AI tools are creating massive operational capacity. I want to drill down into this because every CEO on Wall Street throws the word AI into their earnings call to get a stock bump. But Lyft actually provided concrete metrics on how it is changing their cost structure.
This was one of the most fascinating details of the entire call. Management wasn't just using AI as a buzzword. They were describing it as a fundamental shift in their engineering output.
What do they do?
The CEO explicitly mentioned a new internal AI code generation tool that hit over 80% adoption among their software engineers in just 35 to 45 days. Think about the speed of that internal rollout.
He specifically framed AI not as a tool to initiate mass layoffs, but as a driver of capacity and velocity. Let's translate that into corporate finance.
Sure.
As Lyft expands globally, as they integrate these massive European acquisitions like FreeNow and Getz, as they deal with highly complex European data privacy laws, as they merge different back-end dispatch systems, they have an immense amount of software engineering work to do.
A mountain of work.
Historically, a company would have to hire an army of 500 new developers to handle that integration, which skyrockets your fixed corporate overhead and destroys your EBITDA.
But with 80% of their existing engineers using AI code generation to write boilerplate code, debug systems, and accelerate deployment, their existing team can do the work of a team twice its size.
That's the leverage.
Right. The AI is keeping their fixed corporate headcount incredibly lean, while their actual technical output multiplies. They are scaling their global operations without scaling their payroll.
So to synthesize this massive operational story,
Yeah.
you have high volume secured by DoorDash, premium margins secured by United Airlines and Lyft Black, massive TAM expansion in Canada and Europe, regulatory moats being built in London, external driver costs falling due to organic network density, and internal engineering costs being suppressed by AI coding tools.
It's quite the list.
Yeah.
When you stack all of those operational efficiencies on top of each other, you get a $1.12 billion free cash flow machine.
Yeah.
And understanding that rock-solid foundation is exactly why management feels so incredibly confident about the rest of the year. The business isn't fragile anymore.
Which perfectly bridges us into the future. Let's look at the management guidance, because the market doesn't pay for what you did yesterday. The market pays for what you are going to do tomorrow. And the forecast they laid out is aggressive. For Q2, the exact guidance at the midpoint expects gross bookings to accelerate to approximately 20% year-over-year growth. And they expect adjusted EBITDA to expand by more than 30% year-over-year.
Still expanding,
Again, the profit is growing substantially faster than the revenue and their target for the full year 2026.
The milestone they are projecting is massive. Their full-year target is to deliver north of 1 billion rides.
A billion.
1 billion individual trips facilitated by their platform in a single calendar year.
That is a staggering logistical achievement, managing the physical movement of 1 billion trips. But here's where this deep dive gets really interesting.
The best part.
This is where the entire narrative shifts from how Lyft optimizes human drivers today to what Lyft functionally becomes tomorrow. We have to talk about the AV catalyst, autonomous vehicles. During the call, David flatly stated they are positioning themselves for a global hybrid AV future, and they are extremely bullish about their place in it. What we are witnessing right now is Lyft transitioning from being a purely digital matchmaker between a human driver and a rider to becoming an automated physical fleet operator.
That is the defining corporate pivot of this decade for them. For the last 10 years, the strategic moat of Lyft was its consumer-facing app, its brand, and its pricing algorithm.
This software.
Right. But the actual bleeding-edge technology of the self-driving car itself, the LiDAR sensors, the neural networks, the autonomous decision-making software that is being built by entirely different companies.
Right. They aren't building the robots.
It is being built by giants with bottomless R&D budgets, companies like Alphabet's Waymo and China's Baidu. What Lyft successfully articulated on this Q1 call is that their new strategic moat is not trying to build a better robot brain than Google.
So what is it?
Their moat is their industry-leading ability to physically manage, maintain, and route massive fleets of cars on behalf of those AV tech giants.
The granular details they provided on this were incredible. Let's start with their operations in Nashville. They are partnering directly with Waymo, which is arguably the undisputed global leader in autonomous vehicle technology right now.
Oh, undoubtedly.
Later this summer, Lyft is opening a state-of-the-art 80,000 square foot AV depot in Nashville. We need to talk about the physical reality of this because it changes the company's DNA. Why does a software powerhouse like Waymo need to partner with Lyft to run cars in Nashville?
Because running a reliable rideshare network requires deep, gritty physical infrastructure.
Yeah.
Waymo builds incredible world-class software. Their cars can navigate a complex intersection flawlessly.
But the software can't clean the car.
Exactly. A robot cannot clean up a spilled coffee in the backseat. A robot cannot physically plug itself into a high-voltage charging station when the battery's dying. A robot cannot rotate its own tires.
Right, you need humans for that.
If you are going to deploy 1,000 autonomous vehicles in a city, you need a massive physical footprint. Those cars need daily maintenance. The LiDAR sensors need to be calibrated and cleaned of dirt and bugs. The cars need to be dynamically routed to high-demand areas, like stadium exits, before the demand actually spikes.
It's the unglamorous, heavy-lifting, real-world stuff. And as the CEO pointed out, Lyft actually has a massive hidden advantage here.
FlexDrive.
Right. For the last 10 years, they have quietly operated a subsidiary called FlexDrive. Through FlexDrive, Lyft has managed a rolling fleet of roughly 50,000 physical vehicles that they lease out to drivers. Those 50,000 cars have driven literally billions of miles. Lyft has amassed unparalleled, hard-won expertise in low-cost, high-efficiency fleet operations, vehicle maintenance, and salvage recovery.
Exactly. So what you are seeing in Nashville is a marriage of core competencies.
Waymo brings the brain, Lyft brings the muscle.
That's a great way to put it. Waymo is bringing their world-class AV software and hardware, and Lyft is bringing their world-class physical fleet operations and their massive local demand network. Soon, a user in Nashville will be able to open the standard Lyft app, request a ride, and an autonomous Waymo vehicle will pull up, serviced and dispatched out of that massive new 80,000 square foot depot.
It creates a hybrid marketplace. If it's a sunny Tuesday afternoon, maybe the algorithm sends an autonomous Waymo. If it's a blizzard on a Friday night, maybe it sends a human driver.
Right, it flexes based on need.
But it is all contained within the Lyft ecosystem. And crucially, it is not just Nashville and it's not just Waymo. They are aggressively partnering with Baidu in London. Baidu's RT6 autonomous vehicles are already on the ground right now, mapping the streets of London.
Which is a brilliant geographic and technological hedge by management.
How so?
Well, Baidu is the undisputed powerhouse of Chinese AV technology. The CEO mentioned on the call that he was recently in Beijing, personally riding in these exact RT6 cars, observing their capabilities. But deploying autonomous vehicles in London is a totally different physics and regulatory problem than deploying them in the wide, grid-like streets of Phoenix or Nashville.
Right, London is a maze.
Think about the physical layout of London. You have narrow, winding, historic two-way streets where two cars can barely pass each other. Human drivers constantly have to make eye contact and visually signal to each other, "You go first, I'll pull over."
How does a robot do that?
Exactly. How does a robot negotiate that social contract? Furthermore, you have incredibly strict European data privacy regulators scrutinizing every camera sensor on those cars.
Right, the GDPR stuff.
This is exactly where those European taxi acquisitions we discussed earlier, FreeNow and Getz, pay off exponentially. Baidu does not have the local operational infrastructure or the regulatory relationships to navigate the complex London Transport Authority alone.
But Lyft does.
Lyft does. Lyft is providing the local operational scaffolding to help Baidu launch their technology in Europe.
And they also casually mentioned a new partnership at the municipal level in Hamburg, Germany, aiming to be the primary AV provider there. What we're seeing is Lyft planting flags all over the globe, integrating with different hardware partners, Waymo in the US, Baidu in the UK, local partners in Germany.
A global network.
They are deliberately positioning themselves to become the universal, hardware-agnostic operating system for the entire global autonomous fleet.
It is an incredibly ambitious strategy, but the $1 billion in free cash flow proves they actually have the capital to fund it.
So we have dissected the financials, the partnerships, the algorithmic efficiency, and the robotic future. Let's bring this all home for the listener. We are moving to the final analysis.
The bottom line.
If you are a retail investor listening to this, what does this actually mean for your portfolio? You have to synthesize all of this disparate data to form a cohesive thesis.
And looking at the totality of the Q1 2026 data, I think we have to take a definitive, strongly opinionated position here. This earnings call is an unequivocally bullish signal.
I completely agree. Let's summarize exactly why it's bullish. You have accelerating top-line growth, with total bookings projected to be up 20% next quarter. You have rapidly expanding profit margins, with cash EBITDA projected to be up 30%.
The fundamentals are stellar.
They have a structural, permanent shift toward premium, highly profitable transactions through the explosive growth of Lyft Black and the deep integration with United Airlines. You have a fortress balance sheet with $1.12 billion in free cash flow. And perhaps most importantly, you have a clear, actionable, physically tangible roadmap for integrating autonomous vehicles in the network without having to spend billions on R&D to build the robots yourself.
For the retail investor who is either currently holding this stock or considering initiating a position, the core narrative has fundamentally and permanently changed.
It's not a startup anymore.
Lyft is no longer a speculative, cash-burning tech startup fighting a desperate, endless price war just to survive the next quarter. They are a mature utility.
Yeah.
That $300 million share buyback is the ultimate signal. It puts a firm floor under the equity. It tells the market that the people who know the company best, the management team, believe the shares are deeply undervalued relative to the massive amounts of cash the business is now organically producing.
But looking forward, if you are holding this stock, what is the single most important thing you should be watching? Ride volume is great, but the key metric over the next 12 to 18 months is going to be their physical execution on that Nashville Waymo depot. Why is that specific facility the linchpin for the entire valuation of the company?
Because Nashville is the ultimate proof of concept for the next era of the ride-sharing industry. If Lyft can definitively prove that they can efficiently manage, clean, charge, and dynamically route a fleet of Waymo autonomous vehicles, and crucially, if they can prove to Wall Street that the profit margins on a depot-managed robotic car are superior to the margins of a human-driven car, the entire valuation paradigm of the stock changes overnight.
They cease to be valued as just a software application.
Exactly. They become valued as the indispensable physical infrastructure layer for the entire autonomous future. If the unit economics of that 80,000 square foot depot in Nashville work, it becomes a franchise model. Lyft can literally stamp out that exact depot blueprint in 50 cities across the globe. They become the landlord of the robo-taxi revolution.
That is a profound shift in how the market will value the business. But as always on this deep dive, before we wrap up, we have to look at the other side of the coin.
Of course.
You always like to leave us with a provocative thought, a potential bear case, or a risk factor that the broader market might be ignoring amid all this bullish excitement. What is the thread from this earnings call that investors need to pull on?
Well, there was one specific detail mentioned during the Q&A regarding their marketing strategy that should give long-term investors pause. Management proudly discussed their new marketing campaign rolling out in major markets like San Francisco and New York. The campaign is literally called Check Lyft.
Oh,
They are explicitly actively encouraging riders to open both the Lyft app and their competitor's app simultaneously and compare the prices before booking.
right. The CEO said that their internal data shows when people check both apps, they tend to save money, and it favors Lyft because their algorithm pricing is currently highly competitive. It sounds like a great way to win market share.
In the short term, it is. It absolutely wins them ride volume today. But if we connect this strategy to the bigger macroeconomic picture, think about the long-term consumer behavior they are actively incentivizing. They are spending millions of marketing dollars to train an entire generation of consumers to be ruthlessly, unapologetically price sensitive.
Zero loyalty.
They are teaching their users to have zero brand loyalty, to ignore the interface, and to just blindly click whichever app is 50 cents cheaper at that exact second.
Oh, wow. I see where you are going with this.
So the provocative thought for you to mull over as an investor is this. As autonomous vehicles eventually scale up over the next decade, the underlying cost of providing a ride will inevitably plummet for everyone.
Right, you take the human out of the cost equation.
Waymo, Baidu, Tesla, they will all drive the cost per mile down to a fraction of what it is today. The actual transportation product will become completely commoditized.
Yeah.
If Lyft has spent years aggressively training their riders to only care about the absolute lowest price, will their current pricing power and those juicy profit margins survive the driverless era? Or are they inadvertently planting the psychological seeds for a robotic race to the bottom, a relentless price war where the algorithms just undercut each other until the margins hit zero?
That is a fascinating and honestly slightly terrifying thought to end on. It highlights the incredible tension in this industry. We're looking at a company that has successfully navigated from muddy diagnostic waters and massive cash burn to become a clear, highly efficient, billion-dollar cash printing machine today.
Yeah, they've done the hard part.
But looming on the horizon is the potential for a commoditized, robotic price war. We will have to watch closely over the coming quarters to see if their deep ecosystem lock in things like the United Airlines loyalty integration and the premium TBR corporate roadshows can provide enough of a moat to offset that future commoditization.
It's going to be a wild ride.
Thank you for joining us on this massively expanded deep dive into Lyft's Q1 2026 earnings. Keep questioning the Wall Street consensus, look past the headline jargon to understand the mechanics, stay curious, and keep your portfolio sharp. We'll catch you next time.